Imagine this moment. The market is screaming panic. Red candles everywhere, headlines filled with fear, social media flooded with capitulation posts. Bitcoin drops towards $60,000, and while most people are nervously hovering over the sell button, something completely different is happening in the background. Something you only see if you dive deep enough into the data. While you're panicking, the biggest players in this market are moving quietly, precisely, and ruthlessly efficiently. And that's exactly what we need to talk about right now. Over the last 24 to 48 hours, something has happened that historically has almost always been a precursor to massive market moves. On-chain data shows that wallets holding between 1,000 and 100,000 Bitcoin increased their holdings by more than 40,000 BTC. 40,000 Bitcoin, not over weeks, not over months, but in less than 2 days. These are not random buys. This is not nervous in-and-out trading. This is accumulation, strategic, cold, institutional. If you look at data from Glassnode or Arkham Intelligence, you'll see a pattern that runs like a red thread through Bitcoin's entire history. Every time the market believes everything is falling apart, these addresses start buying aggressively. In 2017, after the China FUD. In 2020, during the COVID crash, when Bitcoin fell below $4,000. In 2022, after the FTX collapse. And even in early 2024, when many thought the halving was already priced in. Every single time, the same psychology, the same mechanics, and every single time, the same winners. The current pullback towards $60,000 feels to many like the beginning of the end. But on-chain, it looks more like a beach ball being pushed underwater. The longer it's held down, the more violently it explodes upward once the pressure is released. The whales know this. The whales act on it. And they use precisely these moments of maximum fear to suck supply out of the market. At the same time, look at exchange reserves. While the price was falling, Bitcoin continued to flow off exchanges. That means these coins are not being bought for quick flips. They're disappearing into cold wallets, custody solutions, long-term storage structures. Exactly where supply becomes illiquid. And when supply becomes illiquid while demand even slightly increases, something extremely dangerous for short traders emerges. A supply shock. Now this is where it gets really interesting. While these 40,000 Bitcoin were being accumulated, derivatives data showed that open interest remained elevated. Many traders shorted the dip, convinced that price had to go lower. At the same time, massive liquidity clusters were sitting just above $66,000 and $68,000. It's like dry wood waiting for a single spark. If price starts moving up and those shorts come under pressure, this can turn into a chain reaction. Liquidation after liquidation. A move that doesn't climb slowly, but explodes. The infamous Omega candle. This is where timing becomes critical. If price stabilizes here and retail stops panic selling, it only takes relatively small additional buying pressure to push Bitcoin very quickly back towards $70,000. Not in weeks, not in months, potentially in hours. We've seen similar moves before, most recently in early 2024, when Bitcoin jumped several $1,000s in a single day after short positions were wiped out. Now let's zoom out for a moment. Why is all of this happening right now? From a macro perspective, we're in an incredibly interesting phase. Inflation is officially under control, but everyone knows purchasing power continues to erode quietly. Governments keep accumulating debt. Companies are searching for hard assets. And Bitcoin is standing here after the latest halving with a newly reduced supply rate. Every 10 minutes, only 3.125 BTC now enter the market. At current price levels, that's less than $200,000 per block. Laughably small compared to the capital that's available institutionally. Samson Mow has been talking for months about a structural supply problem. If nation-states or large corporations even begin to accumulate Bitcoin in small tranches, the market simply isn't deep enough to absorb that without massive price moves. And that's exactly what we're seeing here on a smaller scale. These 40,000 Bitcoin are a preview of what happens when real institutional capital gets serious. Psychologically, This market right now is a masterpiece of manipulation. Fear is being manufactured to shake loose supply. Weak hands sell. Strong hands accumulate. Joe from Horizon once put it perfectly. The market is playing a game you can't see if you only look at price. You have to look behind the curtain. And behind that curtain right now, we're seeing massive accumulation during a phase that's publicly being sold as uncertainty. Historically, moments like this are often the bottom, or at least a very significant local low. In 2020, the market felt dead. In 2022, Bitcoin was destroyed forever, if you believe Twitter. And every time, a phase followed where those who understood that emotions are terrible advisors were rewarded. Not because they blindly bought, but because they understood who was buying and why. What many people underestimate is how fast the narrative can change. Today it's panic. Tomorrow it's breaking news. Bitcoin jumps 10% in a few hours. Then FOMO kicks in. Then you see comments like, "I'm waiting for the next dip." But the dip doesn't come because the supply has already been absorbed. That's why it's so important to watch exchange reserves, whale wallets, and derivatives data at the same time. Price is always the last thing to react. If you're thinking right now, this feels different from normal volatility, you're probably right. This combination of aggressive whale accumulation, shrinking available supply, and a highly leveraged derivatives market is extremely rare. And in the past, it has almost always been the ignition point for explosive moves. Of course, there are no guarantees. Markets remain unpredictable. Macro shocks can happen at any time, but patterns don't repeat by accident. They're driven by human psychology, incentive structures, and liquidity. And all three of those factors are currently pointing in the same direction. Pressure is building. Now I want your perspective. Do you think we're seeing a classic whale trap here? Or is this the beginning of the next impulsive move toward $70,000 and beyond? Drop your thoughts in the comments. These discussions are exactly what help us understand the market better. And if you appreciate this kind of deep market analysis, a like goes a long way in helping more people learn to look beyond the headlines. In the end, one simple truth remains. While the crowd stares at the price, the whales read the data. While many react emotionally, others act mechanically. And while panic is selling, something is quietly forming in the background that could define the next major move. You've just seen insights most people never look at. The only question is, what are you going to do with this knowledge?